I want to start off today by, posing a bit of a riddle to you.
Oh, all right. I love a good riddle.
Okay, so imagine a scenario where the overall economy is just, firing on all cylinders. Businesses are thriving, hundreds of thousands of people are getting hired, unemployment is comfortably low.
Sounds pretty great, right?
Right. But the moment this fantastic news breaks on a Friday morning, the stock market just completely panics, like trillions of dollars in value evaporating within hours.
Yeah, it's wild to watch.
It really is. So the riddle for you, the learner listening right now, is this. Why on earth does objectively good news for everyday people suddenly become, like, terrible news for the world's biggest investors?
I mean, that is the ultimate market paradox, isn't it?
Hmm.
We're all basically taught to think about economic health in a very linear way, like a strong economy automatically equals a strong stock market.
Yeah, exactly. It just makes intuitive sense.
But the mechanics operating beneath the surface are they're much more complicated. And when you look at the incredibly volatile market dynamics from the week of May 31st to June 6th, 2026, answering that specific riddle is really the master key to understanding everything that happened.
Which is exactly our mission for this deep dive. We are going to unpack that paradox by tracking a fascinating triad of markets detailed in a recent Market Watch report.
Right, the blueprint for today.
Yep. We are looking at a blueprint that covers the United States, which the report refers to as the eagle, then Malaysia, which we'll call the tiger, and Singapore, affectionately known as the lion.
And to really grasp the macro battle that defined this week, we have to contrast how the week started with how it, well, violently ended.
It was essentially a heavyweight fight, wasn't it?
Totally. It was boundless AI optimism in one corner and the really harsh reality of interest rates in the other.
So let's start with the optimism. The week actually kicked off with an incredible surge. Artificial intelligence was driving the narrative, as usual, but it was moving in a completely new direction.
Yeah, and NVIDIA unveiled a brand new AI chip.
Right, and what stood out in the source material was the application. Like, this wasn't another processor for a massive remote server farm somewhere in the desert.
No, not at all.
This chip was designed to bring AI capabilities directly into personal computers.
Which is, I mean, that's a massive paradigm shift.
Yeah.
Investors were suddenly looking at the potential for an entire global hardware replacement cycle.
Wait, really? Like everyone buying a new laptop?
Exactly. If every consumer and enterprise suddenly needs to upgrade their local desktops to handle native AI processing, the revenue projections become just staggering.
Oh, wow. I didn't even think about the enterprise upgrade cycle.
Right. Microsoft was riding high right alongside NVIDIA because, their software ecosystems are so deeply intertwined with this hardware push. The market was eagerly pricing in this futuristic growth.
The hype train was moving at full speed. Everyone's calculating future profits. But then we hit the Friday plot twist.
Ah, yes. The jobs report.
The U.S. May jobs report dropped. The data showed the U.S. economy added around 172,000 jobs in May, which was significantly stronger than the market expected.
Way stronger.
And unemployment held steady around 4.3%.
And that data release right there was the catalyst for the absolute chaos.
Which brings us back to the riddle. I really want to break down why this caused a panic, because on a human level, people getting jobs is a positive thing. People having paychecks to spend keeps businesses open.
Right, right.
So why did this trigger massive selling pressure across Wall Street? Is it like a situation where the economy is like a strict diet and the jobs report is a giant, delicious cake? Like, it feels great right now, but it ruins the long-term goal.
That's a fun way to look at it. But let's go with a car engine analogy. An overheating engine is a perfect way to visualize it.
Okay, I'm tracking.
The gasket blowing in this scenario is runaway inflation. The market's ultimate goal, what investors desperately wanted that Friday, was for the Federal Reserve to cut interest rates.
Because lower rates make borrowing cheaper.
Exactly. It allows companies to take out loans, to build new factories, hire more people, expand. It's the cheap fuel for corporate growth.
But the Federal Reserve is playing the role of the mechanic. They're watching the temperature gauge.
Yes. So when the Fed sees a jobs report adding 172,000 new paychecks, they see an engine that is already running incredibly hot.
Because all those people have money to spend.
Right, which drives up demand, which drives up prices. So strong economic data significantly reduces the chances of the Fed cutting interest rates. They feel absolutely no urgency to pour cheaper fuel into an engine that's borderline overheating.
So the market suddenly had to digest the reality of higher for longer interest rates. But let's dig into the actual mechanism here.
Sure.
Why does the Federal Reserve's interest rate matter so deeply to a company like Nvidia or Microsoft? I mean, even if rates stay high, people are still going to buy AI chips, right?
The demand for chips remains, absolutely. But the way we value the company changes drastically. Think of interest rates as financial gravity.
Financial gravity, I like that.
Yeah. High-growth tech companies are valued largely on the massive profits they are projected to make 5, 10, maybe 15 years down the road.
Right. Investors are paying a premium today for that future wealth.
Exactly. But if interest rates are high today, you have a very attractive alternative. You can get a guaranteed risk-free return just by putting your money in the U.S. government bond.
Oh, I see.
Say the bond pays you 5% annually, guaranteed by the U.S. Treasury. To justify taking the risk of buying a volatile tech stock instead, the future earnings of that tech company need to be exceptionally high.
To offset what you gave up by not taking the safe bond.
Exactly. That alternative safe yield pulls capital away from the risky growth bets. That is the financial gravity at work.
So when the interest rate goes up, the present value of those distant future tech earnings gets heavily discounted.
The gravity gets stronger, pulling the valuation of those growth stocks down. And on top of that, we saw the U.S. dollar strengthen significantly on the back of this strong jobs news.
Because higher rates attract foreign capital.
Right. And a strong dollar makes American goods more expensive overseas, which just adds another layer of complexity for multinational tech giants trying to sell hardware globally.
So good news for Main Street literally becomes bad news for Wall Street. And that brings us to the specific fallout in the first market of our triad, the U.S. market, the Eagle.
Yeah, the high-altitude turbulence here was just breathtaking.
It was heavily concentrated in the sectors that had flown the highest earlier in the week. The source material highlights a staggering statistic.
Yeah, the semiconductor drop.
Right. On Friday, following that jobs report, the PHLX Semiconductor Index, which tracks the biggest microchip companies in the world, plummeted 10.3%.
A 10.3% drop in a single trading session is massive.
It's its worst single-day fall since the pandemic crash of March 2020. Foundational players like NVIDIA, Broadcom, AMD, Micron, Intel, Marvell, they all took incredibly sharp hits.
But the severity of that crash requires some context. It wasn't because the AI story was suddenly broken.
Right. People still want the chips.
The underlying demand hasn't vanished. The issue was purely mechanical. The trade was just far too crowded.
Meaning too many investors were trying to do the exact same thing at the exact same time.
Imagine a boat where every single passenger runs to the exact same side to look at something amazing in the water.
The boat's going to tip.
Exactly. The boat itself is structurally sound, but the distribution of weight makes it incredibly unstable. Semiconductor stocks had already skyrocketed in value. Everyone was heavily invested on that one side of the boat.
So the moment the macro environment shifted,
The moment the jobs report hinted at higher interest rates, investors panicked and aggressively started taking profits before anyone else could.
they all rushed to the exit door simultaneously, and the price just collapsed under the stampede.
Yeah, and we saw a secondary factor amplify the panic too. Broadcom released their earnings during this window.
Oh, right. How did those look?
Their AI chip revenue was actually very strong, confirming the real-world demand. However, their forward guidance, like their projection of future earnings, was merely good. It wasn't earth-shattering.
And when a stock is priced for absolute perfection, merely good just isn't enough to sustain the valuation, is it?
Not at all. The market had already priced in a miracle. You see that dynamic play out time and time again. That slight disappointment in forward guidance added immense pressure to the entire semiconductor space.
It just compounded the interest rate fears. So looking ahead, the watch list for the Eagle is heavily focused on stabilization. Like, can NVIDIA and the broader chip sector find a floor?
Right. If they stabilize quickly, it suggests the AI trend remains fundamentally healthy despite the rate fears.
We also need to watch Microsoft and the cloud AI stocks to see if their software revenue models offer more resilience than the hardware side.
And investors are laser-focused on the upcoming macro data too. We have inflation data coming down the pipeline, specifically the CPI, which measures the prices everyday consumers pay, and the PPI, which tracks wholesale costs for producers.
And major tech earnings from Oracle and Adobe. So the overall verdict for the U.S. market is cautiously positive but volatile.
Very volatile.
You have to respect the risk from rates, the stretched valuations, and that crowded boat scenario. But, you know, when that financial gravity pulls money out of overvalued U.S. tech stocks, that capital doesn't just evaporate.
No, it goes looking for a physical foundation.
Right. You can write the most brilliant AI code in the world, but it doesn't live in the ether. It requires massive data centers, specialized cooling systems, and enormous amounts of electricity.
And that physical footprint requires hundreds of billions in capital expenditure. And a huge portion of that funding flows directly out of the U.S. and into our next market.
Yes, let's follow that capital across the globe to the Malaysian market, the tiger. If America is designing the AI brains, someone has to build the physical body.
Exactly.
And according to the sources, Malaysia is uniquely positioned to benefit from this specific infrastructure boom.
The behavioral difference between the U.S. and Malaysian markets this week is actually really striking. Malaysia wasn't moving with the wild aggression of the eagle.
Oh, so?
Well, early in the week, the FBM-KLCI, which is Malaysia's benchmark stock market index, only lost 4.17 points.
That's what? A tiny drop.
It's a 0.24% drop. Very small. The finance index saw slight gains, while the properties index saw slight declines.
It sounds like a much more measured, deliberate environment.
The sources categorize it as a sideways to cautiously positive market. It's a highly selective environment right now. Investors aren't just buying the whole index. They're surgically targeting the specific sectors that are physically building the AI future.
But it's still reliant on global trends, right?
So heavily reliant on broader global risk sentiment, the strength of the local currency, the ringgit, and whether foreign funds are actively flowing into the country to finance these massive projects.
So let's break down the watch list for the tiger, because it perfectly illustrates what it takes to build a physical foundation for artificial intelligence. First up is power and utilities.
Yeah, data centers are incredibly energy hungry.
You can't run next-generation AI processors without massive, dedicated gigawatts of electricity.
Yeah.
So companies like YTL Power and Tenaga National become absolutely critical.
They are quite literally the power source for the AI revolution. An AI data center isn't just a warehouse with some servers. It's a power-dense facility that often requires its own dedicated substations and advanced cooling infrastructure.
So those utility companies are seeing a total transformation in their long-term demand models.
Exactly.
And before you can even hook up the power, somebody has to pour the concrete. That brings us to the construction sector. Building these specialized data centers keeps construction giants like Gamuda highly relevant.
We are talking about highly complex engineering projects here.
Right, not just basic office buildings. And that brings us to the third crucial sector, financials. If the economy is stable and foreign money is flowing in from U.S. tech giants, local banks like Maybank provide the financial backbone.
They're structuring the massive multi-year loans required to fund these capital-intensive projects.
It's a very logical brick-and-mortar way to invest in a highly digital trend. You're buying the utility pole to support the cloud.
Yeah, that's a good way to put it.
But the tiger isn't completely insulated from the eagle's turbulence, is it? There's a contagion risk.
A significant one.
Yeah.
The sources specifically highlight a Malaysian tech company called Inari.
Okay, what do they do?
Inari acts as a semiconductor proxy within the local market. They are deeply tethered to the global supply chain.
So if the U.S. semiconductor index drops 10% because of interest rate fears, a company like Inari is going to feel the shockwave.
Without a doubt. If global chip sentiment weakens, local tech names face severe downward pressure, regardless of how well the local data centers are being built. You just cannot isolate a local semiconductor company from a global macro sell-off.
So to summarize the tiger, Malaysia is busy building the physical infrastructure, capturing that foreign investment, but it remains vulnerable to the macro turbulence coming out of the U.S. Which naturally leads us to a strategic question. If you are an investor watching this intense volatility, the crowded trades tipping the boat in the U.S., the supply chain contagion risks in Malaysia, where do you park your capital so you can actually sleep at night?
You seek out the safe harbor, you look for the lion.
Let's dive into the Singapore market.
Singapore serves a highly specific purpose within this triad. It is the market of stability, dividends, and defensive quality.
So it's less aggressive than the U.S.?
Much less aggressive, which means it experiences lower volatility. Investors who move their money into Singapore are generally prioritizing steady income and capital preservation over explosive tech growth.
But the macro environment, specifically those high U.S. interest rates, still dictates the rules of the game in Singapore.
Oh, absolutely.
And the sources point out a fascinating divergence in how the lion reacts to the higher-for-longer rate reality. It essentially splits the market in two. If I'm thinking about this logically, if high interest rates mean borrowing money is expensive, then the winners must be the ones lending the money.
You see that perfectly reflected in the data. The absolute winners in this environment are the banks. DBS, OCBC, and UOB serve as the heavy anchors for the Singapore market.
Because they can charge more for their loans?
It comes down to their net interest margin. This is the difference between the interest they pay out to you for holding your deposits and the higher interest they charge to borrowers for a mortgage or a corporate loan.
Ah, okay.
In a high-rate environment, that margin widens, meaning the bank becomes significantly more profitable without necessarily taking on more risk.
And investors love that.
They do. They're watching loan growth and asset quality very closely, and they love the strong dividends these banks can pay out under these hawkish conditions.
Okay, so the banks are surfing the high rate wave. The losers, logically, have to be the sectors most reliant on borrowing cheap debt to grow, or sectors that offer alternative yield.
Right. The sources point to REITs, real estate investment trusts, and companies like Capital Land Investment taking the hit.
That is the financial gravity concept appearing again, just in a different sector, right?
Yeah. Exactly. REITs are fundamentally income-generating assets. They own commercial properties, collect rent, and pass that income to shareholders as a dividend.
So if a REIT is paying me a 4% dividend yield based on its rental income, that sounds pretty good in a vacuum.
But we don't invest in a vacuum. If U.S. interest rates stay higher for longer, the yield on global risk-free government bonds go up.
Right.
Suddenly, an investor can get a guaranteed 5% return from a pristine government bond without taking on the headaches of commercial real estate, vacancy risks, property maintenance.
The bond is just easier and safer.
Right. Higher yields in the bond market make the income generated by REITs look much less attractive by comparison, so investors pull their money out, causing the REIT stock prices to fall.
That makes total sense. To tie Singapore back into our overarching AI theme, though, the watch list also includes Singtel.
Yes, the telecommunications giant.
They have significant exposure to telecommunications and data centers. It seems like they bridge the gap between Singapore's traditional dividend stability and the broader digital infrastructure boom happening next door in Malaysia.
Yeah, they offer a defensive, low-volatility way to maintain exposure to the digital expansion.
Okay, so we have mapped out the eagle, the tiger, and the lion. Let's synthesize the moving parts. What are the major storm clouds hovering over all three of these interconnected markets right now?
Based on the Market Watch reports, we can distill the threats down to 4 interconnected macro risks. Number 1, hot U.S. inflation data.
Right, if inflation refuses to cool down.
Exactly. It pushes bond yields up, which violently compresses the valuations of high-growth tech stocks globally.
And number 2 follows right behind that, Federal Reserve rate expectations. After that surprisingly strong jobs report showing 172,000 new hires, the Fed is likely to remain hawkish.
The engine is too hot. Any lingering hope for near-term rate cuts is fading rapidly.
What's number 3?
Number 3 is semiconductor volatility. The fundamental demand for AI technology is phenomenally strong, but the investment trade is incredibly crowded.
The boat is tipping.
Exactly. When everyone is on one side of the boat, any slight disappointment, like Broadcom's merely adequate forward guidance, can trigger violent cascading pullbacks.
And finally, number 4, geopolitical and oil price risks. The ongoing tensions in the Middle East and fluctuating oil prices act as a support mechanism for the U.S. dollar.
When investors are scared, they buy dollars.
And a strong U.S. dollar ripples aggressively through global markets, making it harder for emerging markets to service dollar-denominated debt and affecting foreign investment flows in places like Malaysia and Singapore.
Right. And when you distill all these charts, numbers, and macro forces down, there is a singular vital lesson here, especially if you are newer to tracking these global dynamics.
What's the lesson?
The market proved this week that a phenomenal company can still see its stock price collapse when broader market conditions change.
It's such a counterintuitive lesson to learn. We are programmed to hunt for good companies. Like, NVIDIA makes arguably the most important hardware in the world right now. AMD is executing brilliantly.
They are great companies.
But a macroeconomic shift, like a sudden realization that borrowing costs aren't going down, can crush their stock prices in a matter of hours.
Yeah?
The underlying business can be executing perfectly, but the macro environment dictates the price the market is willing to pay for that execution.
Valuations matter just as much as innovation.
It's like buying a ticket to see your absolute favorite band. The band is currently touring, they are in their prime, and it is guaranteed to be the greatest live performance of your life.
Okay.
But the only way to get in is to buy a front row ticket from a scalper for $10,000. The band is amazing. The experience is undeniably great, but paying $10,000 at the absolute peak of the hype is a terrible financial transaction.
You're going to lose money on that trade, even though the underlying asset is fantastic.
Exactly. Buying a great company at an objectively bad price in an overheated macro environment is a bad trade.
That framing captures the semiconductor crash perfectly. And to avoid buying that $10,000 ticket, the sources provide a rapid-fire checklist you can apply to your own portfolio before making a move in this volatile environment.
Oh, that's helpful. Let's go through it.
Ask yourself, is the stock extended? Has it run up too far, too fast, based on hype rather than current earnings? Is the sector crowded?
Are interest rates moving against this specific type of company? Is the financial gravity increasing on its future earnings?
Is there technical support nearby? If the narrative breaks and the stock falls, where does it realistically land? And most importantly, what is your actual downside risk if your thesis is wrong?
That checklist is a lifesaver when the market gets emotional. Let's bring all of this home. We have covered a massive amount of ground exploring the dynamics of late May and early June 2026.
We really have.
If we do a grand summary of the global ecosystem we've explored today, it looks like this. America, the eagle, leads the innovation. They're designing the software and the advanced processors of the future.
Right.
Malaysia, the tiger, builds the physical infrastructure. They're pouring the concrete, running the cooling lines, and supplying the massive gigawatts of power. And Singapore, the lion, delivers the stability. They provide the banking foundation and the safe harbor for capital when the innovation sector gets too volatile.
It is a beautifully interconnected system where capital constantly flows to find its optimal utility. And as we wrap up this analysis, I want to leave you with a final provocative thought to mull over, building on the vulnerabilities we've exposed today.
Let's hear it.
We have just seen how a single strong U.S. jobs report and the resulting fear of high interest rates can instantly wipe billions of dollars off the valuations of the world's most advanced AI tech giants. Their stock prices are incredibly fragile to macro winds. But those underlying AI models, regardless of what NVIDIA or Microsoft stock price is doing on any given Tuesday, still require massive, continuous, uninterrupted amounts of physical electricity and concrete to function.
They have to exist in the real world.
Exactly. The data centers cannot exist without the utilities. So, looking ahead to the next decade of this technology, could the true inflation-proof winners of the AI revolution actually be the unglamorous utility operators and construction companies building the physical foundations, rather than the volatile tech titans writing the code?
Wow. The classic strategy of selling the picks and shovels during the gold rush rather than mining for gold yourself.
Precisely.
When the gravity of interest rates pulls down sky-high tech valuations, the concrete on the ground doesn't care. The power grids don't care. They just keep operating. It really forces you to rethink where long-term durable value actually lives in a digital age.
It really does.
As we sign off, I want to leave you with one final question to consider for your own portfolio. When you look at your investments right now, are you chasing the overheating engine of high-flying tech hype? Or are you paying attention to the broader macro environment?
Good question.
Which of the three beasts, the high-altitude eagle, the infrastructure-building tiger, or the dividend-protecting lion, best fits your own financial philosophy right now? Thank you so much for joining us on this deep dive. Keep questioning the consensus, keep looking at the mechanisms beneath the headlines, and we'll see you next time.